If you're looking at your monitor setup right now, it probably feels like you're standing in the middle of a casino where someone just knocked over half the blackjack tables.
Oh, absolutely. It's totally chaotic out there.
Right, we've got flashing red and green lights everywhere, tickers moving a mile a minute, dynamic sparkline charts tracing these massive spikes and drops. It's just total visual chaos.
Yep, the screens are definitely bleeding today.
So, welcome to NovaStream. This is your 24/7 live YouTube home for real-time markets and breaking news. I'm your host, saying a quick hello to everyone jumping into the live chat right now.
Great to see you all in the chat.
And we are bringing you your curated highlights of the day. For context, today is Friday, June 5, 2026, and, well, the markets are throwing some massive curveballs across the board today.
Massive is an understatement, honestly.
Yeah, I mean, if you're watching the live crypto ticker right below me, you're seeing Bitcoin and Ethereum just tumbling toward brutal 52-week lows.
It's getting really ugly on that side of the tape.
And at the same time, we're tracking a staggering wipeout in major chip stocks on the global financial indices. Plus, we're simultaneously watching some genuinely wild IPO maneuvering from SpaceX and the quantum computing sector crossing our breaking news feed.
It's a lot to process all at once.
Yeah.
When the screens look like this and the chat is moving this fast, the natural human instinct is to either panic sell or just tune the whole thing out completely.
Flight or flight, basically.
Spot on. But our mission today is to cut through that noise for you. We're going to look past the immediate flashing colors, figure out the actual mechanical forces moving these markets, and, help you understand the larger structural shifts happening right under our noses.
Because the rules of the game are just changing in real time, right?
Right. And just reacting to headlines isn't enough anymore. You need the context.
So let's start making sense of this by looking at the macro realities and the massive shadow that's currently looming over the tech sector.
Let's do it.
Looking at the global financial indices, Broadcom just suffered the largest one-day loss of market capitalization in its entire corporate history.
Hundreds of billions of dollars just wiped off the board.
Yeah. And the ripple effect is so severe that Micron Technology is flirting with a record market cap wipeout of its own today. But the strangest part of this whole bloodbath is that Broadcom's underlying business is actually doing really, really well.
Yeah, they didn't miss their earnings at all. They actually crushed them.
Right. They just declined to increase their AI revenue outlook for next year. It wasn't a downgrade, right? Just a refusal to raise it even higher.
That's the crazy part. It's just this refusal to feed the hype machine.
It feels like the AI market has become this treadmill that just keeps speeding up. It's
Yeah.
no longer enough to just run fast. Like if you aren't running faster than the crowd predicts you will 6 months from now, you just fall off entirely.
That treadmill analogy captures the market psychology perfectly right now. I mean, Wall Street is currently operating in an environment that is absolutely ravenous for material beats and massive forward guidance raises every single quarter.
It's unsustainable, isn't it?
Totally. And that's the trap of the AI trade in 2026. A company can be growing at a blistering pace, practically printing free cash flow, but the stock will still get hammered if the market's imagination outpaces the physical reality of the business.
Because analysts are just assuming perpetual growth.
Absolutely. You have analysts building these discounted cash flow models that assume perpetual exponential growth forever. So when Broadcom comes out and says, hey, maybe we'll just maintain our current incredible trajectory instead of, doubling it again, the mathematical reality of those revised models kicks in.
So it's basically a harsh reality check.
Yeah. Broadcom's drop is a harsh reminder that these AI winners have become so bloated in their valuations that one conservative forecast can literally erase the GDP of a small country in a single trading session.
Wow. But let me ask you this. Should you actually be panicking if you're holding these chip stocks in your portfolio right now?
Well,
Because when you look past today's red candle, the historical data paints a very different picture for how these resets play out, doesn't it?
it does. History argues very strongly for patience here. Let's look at the actual data. Since 2009, Broadcom has had 39 instances of a one-day drop of 6% or more.
Okay, 39 times.
Right. And the median return after those drops, if you fast forward 1 year, the stock was up 61%.
Wait, really? 61%?
Yep. In fact, it was higher a year later in all but one of those 39 cases.
Okay, that is a wild stat.
So the takeaway for you as an investor isn't necessarily to try and catch the falling knife on day one, but to recognize that these brutal headline-grabbing resets have traditionally been enormous buying opportunities. Once the institutional dust settles and cooler heads prevail, of course,
Speaking of cooler heads, I want to look at a piece of breaking macro news that's flashing on the feed right now because it looks terrifying at first glance, but it's actually just a statistical illusion.
Let me guess. The jobless claims.
Spot on. Jobless claims just jumped by 13,000 to a 4-month high of 225,000. People see that number and immediately jump to the conclusion that the broader economy is finally cracking under the weight of high interest rates.
Right, if you just read that headline without understanding the mechanics of how the Labor Department collects data, you might think the dreaded mass layoffs have finally arrived.
But they haven't.
No, don't be fooled by the raw number. This is just a timing glitch on the government's seasonally adjusted data related to the recent Memorial Day holiday.
Okay, so just an administrative thing.
Precisely. Basically, the way they smooth out the data to account for short work weeks gets really messy around late May holidays. It's an anomaly, not a sudden macroeconomic collapse in the labor market. The underlying employment foundation is still relatively firm.
Okay, that is good to know. So if Broadcom is being severely punished for not meeting these stratospheric sci-fi level AI expectations, we have to ask who is actually clearing that incredibly high bar.
Because someone definitely is.
Right.
Yeah.
Someone is capturing that momentum, and that brings us to Marvell Technology. We're waiting on the official announcement today, this Friday, but Marvell is currently the heavy frontrunner for inclusion in the S&P 500 index.
Which is huge.
Massive. Their stock just saw a 33% single-day surge, pushing their market cap over $260 billion.
And crossing that 260 billion threshold puts them head and shoulders above any other eligible contender for S&P 500 inclusion. This is a massive catalyst for them.
Because it forces institutional buying.
Right.
Yeah.
Being added to the S&P 500 isn't just a prestige badge. It fundamentally changes the stock's DNA. Trillions of dollars in passive index funds are legally obligated to mirror the S&P 500.
So they have no choice but to buy it.
Exactly. The second Marvell gets added, those funds are forced to blindly buy the stock, creating a massive, permanent floor of institutional support. And to be fair, Marvell really earned this rally.
They've been making moves.
They have. They just secured a massive 5-year deal with Amazon to design custom AI chips. Plus, Jensen Huang, the CEO of NVIDIA, publicly endorsed their explosive potential.
And the numbers back it up too.
They do. Crucially, Marvell's data center sales have literally doubled, hitting $1.1 billion. They are delivering the tangible hardware reality that the market is starving for, not just theoretical projections.
The hardware is the immediate bottleneck, sure. But I want to pull in a really fascinating note from a UBS analyst that just crossed our breaking news feed.
Oh yeah, I saw this one.
Yeah, it highlights that the ultimate endgame isn't the chips themselves. Amazon, Google, and Microsoft are quietly morphing their entire business models.
They're evolving beyond just hardware.
Right, they're shifting away from just being providers of AI compute capacity, meaning just renting out server space, and are aggressively maneuvering to become AI model and product distribution hubs for companies like OpenAI and Anthropic.
So they want to own the ecosystem.
Exactly. So let me push back on this whole hardware rally for a second. Are these hyperscalers essentially trying to build inescapable walled gardens? Like, are they trying to become the app stores for the AI era?
That is the multi-trillion-dollar question right there.
And if so, doesn't that leave hardware makers like Marvell totally vulnerable once the initial infrastructure is fully built out and the spending finally cools off?
Yes. The short answer is yes. They are absolutely trying to become the app stores of AI. Think about the mechanics of the current tech landscape. Once the physical data centers are built, the real infinite recurring revenue is in distribution.
It's about who owns the customer.
Absolutely.
Yeah.
If Amazon or Microsoft controls the gateway that enterprise companies use to access these large language models, they get to collect a toll on every single transaction forever. They own the customer relationship.
Which puts hardware guys in a tough spot long term.
It does. For hardware makers like Marvell or even NVIDIA, it creates a real vulnerability down the line. Right now, we're in the shovels and pickaxes phase of the boom, so whoever makes the best shovel is king.
Right. Everyone needs a shovel right now.
But once the rail lines are fully laid across the country, the power shifts entirely to the companies operating the trains and selling the tickets.
That makes total sense. But right now, those train operators are facing a massive physical roadblock. To distribute all these massive AI models, you need colossal data centers, and those data centers require staggering amounts of power.
Power is the ultimate bottleneck.
Right, you can buy 100,000 state-of-the-art GPUs, but if you don't have a substation to plug them into, they are just very, very expensive paperweights.
Glorified space heaters.
Exactly. And the U.S. power grid is notoriously slow to adapt, with interconnection queues taking literally years. But the solution to this bottleneck is coming from an incredibly unexpected place. Looking at our auto-curated feed, Bernstein Research just initiated coverage noting that Bitcoin miners are becoming the power landlords of the AI boom.
This is one of the most brilliant structural pivots we've seen in corporate America in years.
It really is.
The biggest bottleneck for tech giants right now isn't raising capital, and it isn't even securing the chips anymore. It's simply time to compute.
What do you mean by that?
Well, building a new data center from scratch involves buying land, getting environmental permits, and then sitting in a grid interconnection queue for 3 to 5 years, just waiting for the utility company to string high-voltage lines to your facility.
Who has time for that in an AI arms race?
Nobody. But Bitcoin miners already solved that exact problem. They have massive operational facilities with high-voltage electricity already flowing. They have what the industry calls warm-powered shells.
Oh, that's a cool term, warm-powered shells.
Yeah. All an AI company has to do is swap out the Bitcoin mining rigs for AI servers, and they shave years off their deployment timeline.
It's the old gold rush saying playing out in reverse, honestly. The people who spent years building infrastructure to mine digital gold are realizing it's actually much more profitable and reliable to just rent out their highly electrified land to the AI developers.
And the sheer scale of this pivot is breathtaking. Over the past 2 years, these miners have signed 17 massive deals to supply 6 gigawatts of power to tech giants.
6 gigawatts. That sounds like a lot.
To put that in perspective, 6 gigawatts is roughly 10% of all the AI data centers currently under construction in the entire United States.
Wow.
We're talking about long-term power contracts valued at over $110 billion. Bernstein specifically highlighted companies like Cipher Digital and TeraWulf.
I was just looking at TeraWulf's numbers.
Yeah, TeraWulf is projecting their AI-related revenue will skyrocket from a mere $14 million in 2025 to $1.7 billion by 2030.
That is absurd growth, and Wall Street is actively rewarding them for giving up on their core business of Bitcoin to embrace AI infrastructure.
They really are.
If you look at the valuations, miners that have secured these AI contracts are trading at a 12.3 times forward sales multiple. To translate that from Wall Street speak, investors are willing to pay more than $12 today for every single dollar of expected sales next year.
Which is a huge premium.
Yeah, because meanwhile, pure Bitcoin miners, the ones sticking exclusively to crypto, are trading at less than half of that, around a 5.9 multiple. The market is literally screaming at them, hey, your electricity is worth significantly more than your algorithms.
But there is a massive casualty in this pivot, you know?
The crypto market itself.
Right. These miners are unplugging their machines and abandoning the network to plug in AI servers. And if you look at our live crypto ticker right now, you can see the collateral damage of that shift.
Yeah, the crypto assets themselves have just hit a brick wall. Bitcoin has tumbled to about $63,600, which is dangerously close to its 52-week low of $60,559.
And Ethereum isn't doing much better.
No, Ethereum is hovering near $1,777. Both of these giants have shed over half their value since their all-time highs in late 2025. So, what is driving this specific collapse today?
We're looking at a convergence of 4 very specific, very heavy macroeconomic and structural catalysts pulling the market down all at once.
Okay, lay them out for us.
First, we have ETF outflows. We've seen over $3.2 billion in net outflows from spot Bitcoin ETFs over consecutive days.
And practically, what does that mean?
That means institutional authorized participants are actively selling the underlying Bitcoin to meet redemption requests from investors who are fleeing the funds. That tells us institutional demand is rapidly cooling.
Okay, that's catalyst 1. What's 2?
Second, macroeconomic shifts. The Federal Reserve has essentially priced out any interest rate cuts for 2026.
Which rids everything risky.
Spot on. When borrowing money stays expensive, risk-on assets like crypto lose their appeal. Investors would rather hold safer yield-bearing investments like treasury bills that guarantee a 5% return without the heart attacks.
I want to jump in on the third catalyst here, because looking at the sparkline charts, you can physically see the waterfall effect happening right now. We're tracking over $1.2 billion in leveraged crypto liquidations in a single day.
Which is just brutal.
Yeah. For anyone new to the stream, this happens when traders borrow money on margin to bet on crypto going up. When the price suddenly drops instead, the exchanges issue a margin call.
They want their money back.
Right. And if the trader can't deposit more cash, the exchange automatically sells off their assets to cover the debt. That forced selling drives the price down further, which triggers the next guy's margin call, creating this brutal, cascading waterfall of selling pressure.
That forced selling is totally ruthless. And it leads right into the fourth catalyst, which is massive corporate selling.
From who?
We're seeing major holders, most notably the enterprise known as Strategy, executing significant Bitcoin sales. Their stock, MSTR, is heavily shorted right now as Wall Street sniffs out the reality that they have to offload their treasury to cover obligations.
So it's spreading beyond just the crypto exchanges.
Exactly. This pain isn't just isolated to the blockchain, it's spilling directly into traditional equities. Coinbase is down nearly 30% year to date as retail trading volumes just completely evaporate.
And Standard Chartered put out a note warning we might see bottoms of $50,000 for Bitcoin and $1,400 for Ethereum before any true structural rebound occurs.
It could get worse before it gets better.
So let me challenge you on this dynamic. You have prominent figures going on financial networks calling crypto a failed asset in this high-rate environment. But in the very next breath, you have long-term bulls on social media screaming that this is a generational discounted buying opportunity.
Right. The echo chambers are loud.
So how does an everyday listener watching our stream actually filter this noise? I mean, if the Bitcoin miners themselves are abandoning ship to become AI power landlords, shouldn't regular investors take the hint and do the same?
That's a really fair question. To effectively filter the noise, you have to separate the fundamental utility of the network from the speculative frenzy of the price action.
Okay, break that down.
Well, the miners aren't necessarily abandoning crypto because they think the blockchain is a failed technology. They're pivoting because they're businesses.
They go where the money is.
Right. The profit margins in guaranteed 10-year AI infrastructure contracts are simply vastly superior and much more predictable than the volatile, cyclical nature of crypto mining.
That makes sense.
As an investor, you have to define your time horizon. If you truly believe decentralized finance still requires Ethereum as its base layer to operate globally, then a 50% haircut looks like an attractive entry point.
But if you were just looking for a quick buck?
Yeah, if you were just riding the momentum of 2025 hoping for a quick flip, the underlying structural reality of higher interest rates is telling you the easy money era is completely over.
The grace period for blind growth is over. And that structural reality carries us right into our next look at the global financial indices, tracking the battle for the everyday consumer.
This is where it hits home.
Yeah, because whether you're selling streaming subscriptions or pallets of groceries, Wall Street is no longer buying into vague tech forays or promises of future dominance. They want to see expanding profit margins right now, today.
We can see that margin obsession clearly playing out with Netflix.
Oh, man, Netflix took a hit.
Their stock is down 24% since their April earnings call. They actually beat earnings expectations, but they refused to raise their full-year guidance, and investors just panicked.
Sound familiar? The Broadcom treadmill.
Exactly. But with Netflix, there's another layer. The extreme reaction is because the structural threat from Amazon Prime Video is finally materializing in a scary existential way for Netflix.
Right, because Amazon has structural advantages that Netflix just fundamentally cannot replicate.
Like the retail integration.
Yes, Amazon subsidizes its streaming service with paper towels and dog food. Amazon Prime Video is bundled with free shipping. When a consumer is stressed by inflation and scrutinizing their credit card bill, they might look at a $15 standalone Netflix charge and cancel it.
But they won't cancel Prime.
No, because they need the free shipping for household essentials. The video service feels quote-unquote free, making consumers way less cost-conscious about it.
Plus, Amazon has a massive established ad tech stack built on actual retail purchase data.
Which is pure gold for advertisers.
Right. They can charge advertisers a premium because they know exactly what you buy in the real world.
So how is Netflix fighting back?
Netflix is scrambling, and their strategy is shifting hard into live events. They're broadcasting the World Baseball Classic, NFL Christmas games, and that massive Tyson versus Paul boxing match.
Trying to create FOMO, basically.
Exactly. They realize that to prevent subscriber churn, Having a deep library of old movies just isn't enough anymore. They have to offer cultural, appointment viewing that you simply cannot miss in real time.
But Wall Street isn't convinced.
The anxiety on Wall Street is palpable because licensing live sports is incredibly expensive, which eats right into those precious margins we were just talking about.
And we're seeing a very similar reality check hit Walmart, too. Walmart was a market darling for years, viewed as the ultimate inflation-proof stock, but it's currently down 12.3% from its mid-May high.
They're struggling to keep pace with Costco and Amazon.
Yeah, and the core reason is that despite all their billions invested in e-commerce and logistics tech, Walmart's business is still heavily dominated by low-margin grocery sales.
It's a brutal trap to be caught in.
How so?
Well, they've successfully drawn in those inflation-fatigued higher-income shoppers, yes. Foot traffic is up. But to keep those shoppers coming back, Walmart has had to keep prices incredibly low, absorbing the inflation costs themselves.
Which absolutely crushes their profit margins.
Precisely. Wall Street is looking at Walmart and saying, hey, it's great that you have foot traffic, but your consumer base is totally tapped out. They're buying eggs and milk, not high-margin flat-screen TVs, and your tech investments aren't translating into the cash flow we modeled.
So in both streaming and retail, the entire narrative has shifted from growth at all costs to show us the durable, high-margin cash flow.
That's the theme of 2026.
To wrap up our breaking news feed this hour, let's look ahead. Amidst all this turbulence with Broadcom's guidance, crypto's collapse, and retail's margin compression, we're about to see a massive injection of fresh capital into the markets via two futuristic IPOs.
I've been waiting for these.
First up, Elon Musk's SpaceX is making its highly anticipated public debut next week. And the behind-the-scenes corporate maneuvering just to secure their ticker symbol is absolutely wild.
It's the ultimate vanity plate.
Tell me about it.
MarketWatch confirmed that SpaceX actually paid Tuttle Capital Management an undisclosed sum to relinquish the ticker symbol SPCX.
They bought a ticker symbol.
Yeah. Tuttle had been using it for one of their special-purpose ETFs, and they abruptly changed it to SPCK back in April to clear the lane. It just goes to show how much branding and narrative matter in these mega IPOs.
They want that instant recognition.
Right. SpaceX wants that immediate, instantly recognizable ticker the second they hit the tape to capture retail momentum.
Wow. Well, the other big debut is happening in a sector that feels straight out of a sci-fi novel. Quantinuum just had its IPO. This brings pure-play quantum computing directly to Wall Street.
And they did it the traditional way, too.
They did. Importantly, they didn't merge with a blank check SPAC company like so many speculative tech firms did a few years ago. They went through the rigorous traditional IPO process, priced at $60, which was actually above their marketed range, raised $1.68 billion in fresh capital, and hit a $15.7 billion market cap.
Which is an incredibly strong showing.
The stock popped initially but closed totally flat, and it's worth noting for governance trackers out there that Honeywell still holds a massive 49% voting stake in Quantinuum.
The fact that they successfully raised nearly $1.7 billion through a traditional IPO for quantum computing, a technology that is still largely theoretical in terms of commercial profitability, shows that institutional investors still have a massive appetite for generational technological leaps.
Even in this cautious, high-interest rate market.
Yes. Wall Street desperately wanted a pure play option in this space. They wanted a stock where 100% of the company's focus is on quantum, especially with the U.S. government pouring billions in federal funding into the sector to compete globally.
You know, looking at Quantinuum's quantum processors and SpaceX's commercial spaceflight hitting the public markets, it makes me wonder, are we literally watching the seeds being planted for the next decade's mega-cap giants?
It's a great question.
Like, are these the companies that will eventually unseat the Broadcoms, the Marvells, and the Amazons at the very top of the S&P 500?
Honestly, it's highly likely. If you zoom out, quantum computing and space logistics are the foundational infrastructure for the next 50 years, much like data centers, fiber optics, and cloud servers were for the last 30.
It's the next layer of the foundation.
Right. Historically, the companies that build the base layer infrastructure of the next technological epoch are the ones that capture the lion's share of the value.
That is a great perspective to end on, and that brings us to the close of our stream for this hour. Thank you so much for tuning into NovaStream and catching our highlights of the day.
Thanks for having me.
Navigating a 200-for-7 market requires a lot more than just reacting to the headlines or panicking at the charts. It requires looking past those daily red and green arrows to understand the structural shifts moving underneath the surface. We really appreciate you spending your time with us, interacting in the chat, and keeping the stream running. Goodbye for now, and we'll catch you on the next live update.
Before you close the tab, I want you to look back at those flashing screens and consider the through line of everything we discussed today. We've seen Amazon shift from being a simple bookseller to a cloud provider to an AI model distributor. We've seen Bitcoin miners abandon their algorithms to become physical power landlords for the AI boom. It raises a profound question for how you structure your portfolio heading into this weekend. Are we entering an era where a company's original product matters far less than the sheer physical infrastructure and distribution networks they happen to sit on?